What's up, trader? Do you know that the presence of a second high or low makes the first high or low stronger? And that would mean that price will always seek to take out that second high or low. Now, this is a concept called liquidity. Now, I will explain what I just said with this past diagram and show you in charts how you can trade with these ideas in mind. First off, you see price in a downtrend declined this way, then created a sub high. That high becomes the second high after the first one. Expect price, if the downtrend should continue, to take out that second high and then go lower. This gives you some of the best entries, sniper if you like, in the market space. That is for a downtrend. So you expect price to take that high out and decline. Also, in an uptrend, this was a push or a move, and then price created a second low after the first low. The presence of this second low makes the first low stronger, so price would oftentimes come lower to take out this second low and then expand to the upside. If there were no second lows or highs, expect the very only high, as it were, or low formed to be taken out. But for this quick training video, I will just stick with this idea and explain further. So let's look at a couple of examples in the chart. And by the way, this works across any financial asset and across any time frame. You just have to know two things. Number one, know the bias, that is the direction of the market from simple market structure. And then two, know the liquidity, the highs or lows that are formed afterwards. This is a downtrend example. The first example is a downtrend example. What price did right here, like you can see, it created high number one, it came down, formed the second high, and went lower. So what do you expect price to do? Come back to that level, take it out, and decline. Simple. This is not a pick and choose example. This happens all the time. Let's go to another example. By the way, this one you see up here, I may not be able to explain because that level was a second high. Okay, let me zoom in so you see that was a second high from a distant price drop. Look at it right there. This high was formed, price rallied lower, pulled back and created that high, and then did all it did for several days into weeks. Price came back stylishly, take out that second high, which is a liquidity entry. Then we made a nice 1 to 6 risk to reward ratio. In fact, insane amount of return on that particular trade. Now let's look at two examples from the buy side. Very simple concept. Very simple. You have to have someone to make you not understand it. In this example of a buy side, note that buy side liquidity. So price took that out, all right, and then it retraced back to form a low right here. That low becomes your target liquidity. So you see how price came back and picked that low. And one thing I want to take note of is the reaction after that low was taken out. The reaction was impulsive. It was impulsive. I'll give you one more, or just two more, on the buy side example. Doesn't this look like the earlier example we started with, or the diagram I drew? This, expect that to fail, price comes back, and that happens. So what can we see? This was the low that started the move. Price went that way, came down, went up. That low that was created, the second low, notice how price came all the way down to take it out, and boom. So I'll clear it out for you to see what I'm showing. Let me zoom one more time inside. You see that 1, 2. The second low should go. Boom. That goes. Look at this new one. This one, that 2. This 2, that second one should go. Price came, took it out, and boom. I can go on and on and on to show you these examples. It happens all the time in price, and it's actually a high risk to reward ratio. Obviously, there are other things or a few other moving parts or mechanism to these trades, how that you can expect price to go into something and move on. Now, if this trading pattern seems simple and resonates with what you want to learn, we have put together this material, the concept in a material titled the One Trade Pattern book. Now, this is a soft copy material that has videos that explains all of these things we talked about, and most importantly, there is a community online that will meet virtually every day to look at the market and explain all of these things. So you have expectations, you have videos, you have PDF to guiding you to understand all of this. A very simple market model. Now, for today only, this material, the book, the video, access to the community, and other bonuses goes for $4.99. $4.99, or 3,500 naira, or 56 Ghana cedis if you are a Ghanaian. Now, all you have to do, and it's a discounted one-time only offer, click anywhere in this video and make your purchase right now, and upon successful purchase you have access to all of these materials and the community as well. You need to learn to trade with market structure and liquidity only, then this is for you. Click anywhere in this video, process your order for $4.99 and get started ASAP. I'll see you on the other side. Jay Okoli signing out.